Welcome to We Are Old, Get Over It, the podcast where we celebrate the wisdom of age and maybe a little grumbling too. Our guests dive into topics that matter most to us, from navigating the digital world to embracing new adventures and the challenges that hold us back. Join me for about 30 minutes of insightful conversations, honest reflections, and a whole lot of get over it attitude. So let's get started. Welcome back to the podcast, and welcome to our continuation of our first season. Many seniors worry about leaving their loved ones financially burdened. Today, we're going to demystify life insurance and explore options for those over 60. It's my pleasure to introduce Lee Scher, who has recently retired. Is that right, Lee?
That's correct.
Okay.
But I still help some of my existing clients.
Okay. And why don't you give us a little bit of background, and then I'm going to let you carry the conversation, and I'll try to keep out of it as much as possible.
Okay. Thank you, Ken.
You're welcome.
Yes, I've been, as a second career, 28 years ago, I got involved with the life insurance industry. And my first job was with Northwestern Mutual, one of the finest life insurance companies in America. They've been around for more than 150 years. The interesting thing about that, on the first week of the job, they told me to go to Milwaukee to go to the annual conference in front of 6,000 other agents. And there I learned who were the best insurance agents in the country for Northwestern Mutual. And to my surprise is that there was a guy that sold over 6,000 policies in a year. And I said, that doesn't add up. Those numbers don't add up. How many hours in the day are there? Well, by the third day of the conference, there was an award for community service. They gave the agent $10,000 for building a local community park. And I said to my general agent, I think I could win that. I have no idea how I'm going to do that, but that's on the table. Selling those many insurance policies, that's not me. So it was an interesting introduction to the industry. Now, 28 years later, I'm retired officially. However, I do help my existing clients with Medicare Part D for prescription drug plans. And I do that because I just want to stay in the industry. It's not a question of earning anything. It's just a question of helping my existing clients. Sometimes they would say to me, my brother's turning 65. Can you help them? And I said, sure. But for the most part, I enjoy playing golf, tennis, and my kids are out in California, so I visit them. And my retirement is something that was planned, and it is working for me. The way the images that Fidelity and Merrill Lynch spoke about, that you'd be traveling, seeing your family, and just playing golf, tennis, whatever the retirement lifestyle vision was, I'm living it and am enjoying it.
Well, that's wonderful. So why don't you give some advice to how you can assist people, not personally, but giving them the information that they need to make decisions for themselves?
Be happy to. So when someone retires or is thinking about retirement in their pre-retirement years, and it doesn't really matter if they're turning 65 or turning 50 or turning 75, one of these days they get tired of working. Sometimes health gets in their way and forces them into retirement. Or there's a budget cutback for a company that they work for and they're forced into retirement. And so at that point, they have many things to consider. And number one on the list is probably finances. Will I have enough money to last me, we'll take a 65-year-old, 30 years? Many people are living past age 95, and have they saved enough money to do that? Did they do it in a retirement plan like a 401k or an IRA? Or do they have an investment account with one of the wirehouses of Morgan Stanley or UBS? Or do they have money in cash value life insurance? So once they realize that they will be getting Social Security, and again, they have to work 40 quarters in the United States to be able to get Social Security, and depending on how much money they put into it, will determine how much money on a monthly basis they will receive for Social Security. The Social Security retirement age keeps going up. So presently it's around 66 and 10 months, or 67, and what that means is you you could always work, but once you decide to collect Social Security, if you make too much money before your full retirement age, you will be penalized. And so once you pass your full retirement age, you're able to make as much money as you want. But if you start taking Social Security at 62, then you're limited to about $20,000 a year in income, or else anything that you make over it, Uncle Sam is going to give you a big haircut. They're going to give you perhaps 50% tax on making too much money. So you have to get to the full retirement age according to Social Security. And once you do that, you'll be able to get that type of income. I'll just use general figures, but each person is different. Knowing Ken the way I know him, most of the people that he works with have in the past have had relatively high income. So we'll just say on a low, they can make $2,000 a month in Social Security, and a high, they can make $3,500 to $3,800 a month in Social Security. Now, the longer you wait before you take Social Security from age 62 on, you get about a 7% increase each year if you don't take it. So at 62, if you decide to take it, um, then then you'll just get paid. We'll just use $2,000. At 63, you get a 7% increase to that, and that would be 7% over $60,000, and then we'll just say it's 62,000, and then it's $2,200 a month, and then it goes on to age 70 and a half. After age 70 and a half, you can't get any more than that. So some people wait because their advisor says you'll get a bigger monthly income, and some people say, well, I need the money now. I have some health risks, and I'm not quite sure if I'm going to live a long life, so I want to get the money as soon as possible. Now, we all know $24,000 a year is not going to give you the retirement lifestyle that you want, but it is important because it is perhaps one of the only checks that you're going to get on a consistent basis.
Right. Like my check comes the third Wednesday of every month, I think.
Right,
They never miss out.
right. Well, they never miss out. And again, this is not a political thing. There's been a lot of talk in the newspapers that the present administration wants to reduce Medicare, he wants to reduce Social Security, and nobody knows what that means, and nobody has a crystal ball. So it is a little bit upsetting for retirees that hear this on the news, because they can't get a grip of, are they going to stop my check?
Right.
How is that going to work? Because I need that check. I need that check to pay for my car payment, to pay for whatever I need it for, rent, mortgages. So so that's one good thing about retirement, is that all of a sudden when you do decide to retire, you will get this money that you've saved through the Social Security um, environment that you pay tax on for all these years. You now have a pool of money that will last you for the rest of your life. And then if you're married for at least 10 years, then your wife will be entitled to that if you pass. In other words, if I make $2,000 a month in Social Security and I'm married for 10 years and my wife makes $1,000 a month, so together we're making $3,000 a month. But if I was to pass on, she would get the higher of the two numbers, which would be the 2,000. In other words, we're as a family unit. Not only did I die, but her Social Security is adjusted. She loses her Social Security. She doesn't get both. She only gets the higher of the two payments.
Well, that's good information because many people always talk about that. What happens if my spouse passes before me? What do I do about Social Security? And you just answered that question.
Right. So, you know, let's say, as far as life insurance is concerned, we'll start from the basics. In the beginning, when you're married in your 20s or early 30s and you start to have a family, if they hear through the grapevine or through their family about have you ever considered life insurance? And I'm not talking about looking at a commercial on television. I'm just saying in general. So if something should happen to the breadwinner, whoever that might be, the woman or the man, and that income stops, life insurance is one way to satisfy that. So some people have a choice when they're young to either buy term insurance or permanent insurance. Permanent, sometimes known as whole life or universal life. And there are two different products, but those permanent insurance policies last your whole life. But your child, in your case, they're going to last. They're going to be around for 20 years, and then sooner or later they're going to be independent. So the reasons for having life insurance are changing, meaning that you needed $1 million of life insurance when you were young, not because you won the lottery, but because it could give you $50,000 a year of income if you put it in an investment account earning 5% per year. That's not a lot of money, 5%. But after the 20 years, so to speak, you have $1 million, you spend $50,000, you receive $50,000 of income, and you still have $1 million at the end of 20 years. So that's the thing about life insurance, is that if you die too soon or get sick when you're young, when the life insurance premiums are relatively inexpensive, that is the sweet spot for you. That's the sweet spot for the insurance companies, knowing that you're not going to die in the next 20 years.
Mhm.
So if you purchase it at 25, it's rare that you're going to die at 45. Yes, it does happen.
Of
And
course.
and the life insurance piece, when it does happen, really helps the family move on financially. When you get older and the kids are out of the house, you would say, what do I need life insurance for? Well, at that point, you're married for 20 years and hopefully happily married. And if something should happen to you then, you still have rent obligations, mortgage obligations, um, car, and just lifestyle. And would you want your spouse not to have anything because all of a sudden your income has stopped? And so, yes, you need life insurance between the 40s and 60s. And then you start thinking about, wow, what about leaving an inheritance? Well, it might not that be important to some people, but what easy way to leave an inheritance is through life insurance. And if you had whole life insurance, it's almost like a permission slip to spend everything else, because if you die in your 80s, it's going to replenish all the money that you spent between 60 and 80.
So what
So
you're really saying about that is if you took a whole life insurance policy or universal policy, is that what it's also called?
either one, right?
Yeah.
They're two different ways.
And you took a policy when you were younger and you took a $500,000 policy. What you're saying is that if you die, or when you die, because we're all going to die at some point,
Right.
that really offsets the money that you would be spending on yourself and your spouse on your travel while the time you're retired, and then you've left an inheritance by having that insurance, correct?
Right. And or left enough money for your spouse to live through the 90s or
Yes.
something like that. So,
Hmm.
yes, insurance agents get a bad rap for trying to convince their prospects, soon to be clients, to buy whole life insurance rather than term insurance. Now, term is typically renting insurance, just like you rent an apartment for a year. At the end of the year,
Hmm.
that rental is over. Then, in simplistic terms, universal life is renting insurance for your entire life. There has to be some adjustments because you could make the premium less expensive if you only want the insurance to go up to age 90 or 95. But whole life will last your whole life even if you live to 121. Now, just to give you, or your, just in general, if term insurance costs, when you're young, costs $1,200 to get $1 million of coverage, universal life probably cost you $5,000 a year for the same coverage, and whole life insurance in your 20s would cost you $12,000 a year. So most people in their 20s don't want to write a check for $1,000 a month to pay for insurance for the rest of their lives. And that's why most people gravitate to term insurance until they're more financially stable in their mid 30s to mid 50s, depending on when they have enough money to pay for increased premiums.
Let me ask you about the term insurance a little bit. I experienced term insurance. I took out a policy was good for about 10 years, and when basically term insurance is you're betting you're going to die, and they're betting you're going to live. Is that accurate?
Correct. Yes. And they know you're not going. They know you're not going to die in the next 40 years or
Hmm.
20 years, as long as, or in your case, a 10-year term policy.
Right.
So
But
again, okay, if you have a 10-year term policy versus a 20-year term policy, the 10-year term policy is less expensive each year than the 20 years,
mhm.
and the term rate stays the same throughout. In your case, all 10 years, or in a 20-year policy, it stays the same.
Hmm. But then let's say that policy expires, you're in for sticker shock.
Well,
Let's
you're
say
in for
10 years
sticker
later,
shock.
and you say, well,
There's
I
a,
want more
again,
insurance.
right. So this is not a salesy way of looking at this, but when you apply in your 40s, it's a whole lot more expensive
Yes,
than applying in your 20s. And when you're applying in your 60s, it's a whole lot more expensive than you're applying in your 40s.
because it goes back to my theory of you're betting you're going to die and they're betting you're going to live. Well,
Right.
you got to pay more to get take the bet.
Right. So if you are able to, again, life changes. Are you able
Yes.
to stay in the same job? Are you upwardly mobile, or are you going to be moving from one career to the next? And at what
Hmm.
point are you comfortable in buying insurance? Now, with auto insurance, which is completely different than life insurance, auto insurance says, yeah, I'm paying thousands of dollars each year to insure my car, and I wasn't in an accident. And the next year you have to do it again, and I wasn't in an accident. You're going to be paying auto insurance for the rest of your life, not seeing a benefit until you get in an accident. And so it works the same way with life insurance. Oh God, I just I just spent $1,200 and it seems like it's lost. But at 75 and you're spending $1,200, you say, well, it's more likely that I'm going to die sooner than later. And then I'm glad that it's only $1,200. That's because I was smart enough to purchase a universal life policy when I was much younger. And what the insurance companies also do, because I wouldn't say they're tricky, but they basically say, um, we only want the best and the healthiest people to be able to get our insurance. If you're sick, then they adjust the price higher, of course. If you smoke, it's 30% higher for the premiums. And so, and if you have a lifestyle of race car driving or parachuting or bungee jumpings, the insurance companies are not going to give you the lowest price to buy their life insurance. They take lifestyle, your health into consideration of giving you a contract, a life insurance contract, which basically says, I'm renting it for 10 or 20 years through term insurance, or I'm buying whole life insurance that will last my whole life. But they're going to, depending on the circumstances and the amount of insurance coverage, you'll fill out an application that could be quite long and ask you lots of medical questions. Then, depending on the size of the amount of insurance that you want, they might provide a paramed exam, and then they're going to look up your doctor's records to make a decision whether they should accept you or not. And then,
Okay, I have a question.
sure.
Let's talk a little bit about the things that determine the coverage that you need, such as your final. What does it pay for? Does it pay like your final expenses, things like
So,
that?
right.
Let's talk
So
about
the
that.
life insurance companies, they don't really care what you spend the money on once you receive the benefit. Someone died and they have a beneficiary listed or two beneficiaries listed. The first beneficiary is usually the primary beneficiary, and the second beneficiary is called the contingent beneficiaries. So let's say, Ken, you decide to leave all your money to your wife, but your wife passed on. So you might have, if you have two children, you might say 50% to my daughter and 50% to my son, and that's called the contingent beneficiaries. Now, let's say, depending on the size of the policy, whether it be 100,000, 250,000, a million, 3 million, 10 million, it doesn't really matter. Once you get the check, you can spend it any which way you want. Now, what happens with people in their 50s and 60s, they realize, yeah, they have some savings and they have some money that they were planning to use it for insurance, for their lifestyle and living. But we need to talk about our funerals and where are we going to be thereafter. And so final expense policies, which are often seen and sold on TV, where they said, well, for $6 a month, we'll get you $25,000 of coverage. And what that basically means is that's going to that's going to give you $25,000 to hopefully pay. You don't have to use it for the funeral. You could use it for anything you want to use it, but the funeral home is going to say, do you want to be cremated or do you want to be buried? And do you want an expensive casket or do you want an inexpensive casket? And so from the funeral homes, because they just want the money up front. And one way of getting that is through a final expense policy, which is typically around, it starts at it starts at 5,000, but most agents would start at 10,000 and go up to $25,000 for the most part. And there you're only spending, depending on the age, of course, from $50 to $100 a month instead of a ridiculous amount of money when you're looking in your 60s for life insurance.
Let me go
And it's
back
a
for one
simple way.
second. I'm sorry.
Sure.
Let me go back for 1 second. Let's go back to the beneficiaries. Uh, Going back to your model, saying that you passed, and then these funds are available to them. Let's say it's $100,000. Is that taxable?
No, with life insurance, it's not taxable. There are a couple of ways that it is taxable if a corporation is paying for the premiums. But if you're personally paying for the premiums with after tax dollars, typically, then you will receive the money without taxes.
Okay.
However, if you're having a payroll deduction from your company to buy the company's life insurance, then since you are using uh, after
Pre-tax.
tax, pre-tax dollars, then
Right.
they're going to tax that.
I
Most
understand.
people have, most people pay for it personally, um, and then they get the
Yeah.
money
I think
tax
that's an
free.
important point that you don't pay taxes on that. Different than when you're pulling money out of your stock account or something like that, where you would have to pay taxes in many cases, probably in all cases.
Yes, and in most cases, all you need is a death certificate, and in most cases, the life insurance will pay sooner than the brokerage accounts. It could
Hmm.
take you, or the banks, it could take you months to get paid um, from the brokerage houses, and it could take you months in the same case with the banks. So life insurance usually happens pretty quick. It's very simple. Just show a death certificate, fill out a form, and within a week or so, you should be able to get it.
Good. Let me ask you another question. Are there any scams that people should be aware of as they're older? Or are people aren't knocking on your door, but they might as well be if you have a phone or a Gmail account or some other account. What are the scams that are out there that people need to be aware of?
Okay, so this is it's a hard. I'm not going to use the word scam, although I understand exactly what you're talking about. So now that I'm above retirement age, I'm 72 years old, and I'm getting invited weekly to have a steak dinner on a postcard to someone I don't know in a local restaurant.
Right.
And we'll say the postcard says 10 ways seniors screw up their finances. And would you like to have a steak dinner at Ruth Chris or, Morton's or any other place?
Right.
And you say, honey, you want to hear what this guy has to say? And then you go into the room and you start listening to someone talk about how seniors screw up their finances. And he says enough, gives you enough stories to tell you, yeah, that could happen to me, or I didn't think about that. And so the whole point of that dinner is to get you to have an individual appointment with a financial planner. Now that person is really trying to help you, but he's also trying to help himself. He's
Of
trying to
course.
sell you a commissionable product. He's trying to recoup the costs that it costs for inviting you to an expensive dinner. The most expensive cost that he's trying to recoup is the mailing cost. At 75 cents a letter now, he has to mail perhaps 5,000 invitations to get 50 people in the room. And so he's built up, perhaps $10,000 of expenses, and he needs to get that back. So he's going to hard sell anybody that is interested in listening to him on a one-on-one appointment. Now, he's not really scamming them. He's really trying to help them, but he's also trying to help himself. If he sells an insurance product, in all likelihood, he's going to get a commission.
Also,
The
go
Go
ahead.
ahead.
I'm sorry. I didn't mean to
The
step on
people
you.
that the people that usually do this are normally talking about fixed annuities, long-term care insurance, and they're talking about highly commissionable products. The the brokers from Morgan Stanley to Raymond James to UBS, they don't have commissionable products. Their model is assets under management. So they typically do these seminars, but they're not mailing 5,000 blind invitations. They're asking their existing clients to bring a friend into
Hmm.
the steak dinner,
So this
so
is
they
like
would be introduced to them.
so this is like the pressure that's done on timeshare, just a different way.
Uh, yes,
Okay.
again. Um,
That's a good
a
short
financial
answer.
advisor, if he's successful, he has to be a very good salesperson.
Yeah.
And he's a good salesperson by listening, and
Mhm.
he's a good salesperson by telling stories from experience. Not because he read them in a book, just because, he's experienced so many different issues. The best life insurance agents or financial advisors actually had the most problems throughout their career. They dealt with more issues than the person that is less successful because that person never experienced all those issues.
Okay. So, do you have a good story to tell me, something happy about the insurance business and what your experiences were in it, or yeah, were in it because you're really not doing it anymore?
Okay, so I had a friend. The first people that life insurance agents speak to is their family and their friends. And of course, once they're in the door and they make the sale, then they ask their friends and family, "Do you have any other friends and family that you could introduce me to?" Well, one of my friends was very, very successful. He used to, um, believe it or not, he was a high school educated guy, and then he decided to open up a shop, an audio shop that would sell 8-track cartridges. He would put 8-track audio cartridges into a car, and then later on it went into cassettes, and the supplier later on got him into cell phones, car phones. If you remember, they were the
It
size of
sounds like a movie.
Yeah, it sounds like a. So all of a sudden, he's got this Brooklyn shop selling car phones, which became mobile phones, and his first large account became Macy's selling mobile phones. I remember going on a chairlift with him skiing, and he showed me the Motorola flip phone, and then we called up a friend. We're in Colorado, and we called up a friend, and it was the most ingenious thing I ever saw. Anyway, um, yeah, he bought $2 million of life insurance. And at 38, he died of a heart attack.
Hmm.
And then when we gave the wife the check of $2 million, she said, "How much did it cost?" "Ah, eh, I don't know. It cost $1,500, about $1,500 a year because he bought it so young. And why didn't he buy more? Was the answer. To make a very long story short,
that's that's a
she
good
she
story.
she eventually became president of the company and
Yeah,
sold the company for $50 million.
there you go.
And the company is no longer around.
Yeah,
It was, if you remember years ago when the cell phone started happening, they had lots of different cell phone stores, but eventually it was Verizon, T-Mobile, corporate
right.
stores and none of the small stores, opened it, did
Well,
this.
that's a good laugh. Of course.
Yeah,
Why didn't
yeah.
he take more? He's supposed to know he was going to die.
The sad part of this, that they had a child. They were friendly with my kids were friendly with their kids, and the son died at 36.
Mm,
He died at 38, and the son dies at 36. So it was just because you have a lot of money doesn't mean life doesn't happen.
no.
Ken, it's important that I want to get this one point across about
Sure,
long-term care
please.
insurance. So when people in retirement, they're thinking about living and not losing money. But the health care is the issue where they could eat up lots of dollars of what they didn't plan on. So long-term care insurance is basically an insurance, again, that the long-term care insurance companies think you're not going to get sick or need help, but you're going to
Mhm.
need help for activities of daily living, which including to walk, to get dressed, to take a bath, to go to the bathroom, to transfer from the bed to the floor. And these are not medical expenses. These are non-medical expenses. And if a spouse has Alzheimer's or had a stroke, and the people's retired. I mean, they're in their 80s, and something happens, and then Medicare will pay for their health while they're in the hospital or going to a doctor. But who's taking care of them? And that's where long-term care insurance is important. I've sold a lot of long-term care insurance throughout the years. Some people are using the claims. The premiums are not guaranteed. They're guaranteed renewable, but the premiums can go up in time. And it's a difficult conversation when they do raise the premiums, but that's because too many people are going on claim, and the company needs the money to pay for the promise that we will take care of you.
Hmm. So, how much do the long term
Care
insurance
insurance. So
care insurance cost?
well, we'll use my example. I bought mine in my late 40s because I was in the business, and I pay $179 a month. We purchased the policy on my wife when she became 60, and she's paying $550 a month.
Mm.
And the difference is my pool of money was building up for 20 years before she started it. Typically, if someone, the sweet spot is before someone gets sick and takes too many medications to be approved. So once you start taking multiple medications, the insurance companies are concerned about arthritis and the fact that you might not be able to get dressed by yourself, or do you have you know, a heart condition or cancer condition. You signed it while you were healthy, but moving forward, you might not be so healthy.
Exactly.
So in your 60s and 70s, it's very expensive. In your 70s, it's almost unheard of an insurance company approving you. So
Mm.
it seems to be getting younger and younger when people are purchasing this. But again, if you have that policy, you're never getting rid of it because you're that much closer to using it. In the beginning, you just feel like it's a waste of money. But
Right.
as you age in your 60s, and then you ask people, do they have it? They said, no, where can I get it? And they says, how come you're only paying $3,000 a year? And the guy you sent me, he says it's $12,000 a year. Well, that's because we're trying to get a pool of money with a shorter amount of years.
Right. Is there
I
anything
like to
else that you want
briefly
to go?
go
I'm
ahead.
sorry. Is
I
there
like to
anything else you
briefly
want to
talk
mention?
about Medicare.
Sure.
And there's two types of Medicare. There's the Medicare supplements and Medicare Advantage plans. The supplements give you no networks. You could go to any doctor um, throughout the United States. 99% of them take Medicare. And Medicare Advantage plan is not really an advantage. You have to use their network of doctors. So if someone is traveling, they have to get their Medicare coverage within their own county. We always encourage supplements if they could afford them.
Hmm. That's great. Okay. Any last thoughts you'd like to share with us?
Well, I wish you much success with this podcast. It's very important that seniors or old guys like myself are hearing information that you're able to present to them, not only on financial aspects, but other senior issues. And I wish you all the luck in the world with this. It's
Thank you.
very, very cool. And I thank you for the time.
Okay. Thank you very much, Lee. And I'm at the end of each podcast, I'd like to read a quote, and usually they're from somebody famous. This one's from somebody called Unknown, and I try to get something that relates a little bit to what we're talking about. And this quote is: "Do not regret growing old. It is a privilege denied to many." So, with that, I will thank you again, Lee, for taking your time and getting off the ski lifts and getting off the golf tournament and sharing your expertise with us today. Okay, my friend?
I appreciate it, Ken.
Oh, it's my pleasure.
Good luck to you.
Thank you
Thank
very
you.
much.
All right.
And that concludes this episode of We Are Old, Get Over It. Thanks for joining me. I hope you found our conversation both insightful and entertaining. Remember, age is a journey, not a destination. So embrace the wrinkles, the forgetfulness, and the occasional tech frustrations with a good dose of get over it attitude. Until next time, keep laughing, keep learning, and keep getting over it. Ken out.